welcome to the special series Global Mantra Outlook 2013. This is a show that profiles prominent fund managers from the City of London and gets their views on the global market situation. Joining me on the show today is Masha, Head of Emerging Market Equities at PIMCO. Masha, it's great to have you on the show and great to connect with you again. Do you think the start of the year would be essentially a nervous one on account of the fiscal cliff and how that issue is handled? Could we brace for a sell-off when we start off the year?
I suspect some sort of deal will be struck by the end of the year, but that any deal would, in the United States, would still spell some fiscal contraction. And then the question mark will begin is as to where the deal or the components of the deal dent business confidence going forward. So clearly the tax on the rich and expiration of some other very important gestures that were implied in the budget before is likely to dent business confidence. So I think the balancing factor is the robustness of the housing recovery. The China factor will need to be strong enough to offset that contraction.
But stepping into 2013, are you feeling a bit more confident than when you stepped into 2012? Because we saw a year-end sell-off and a pretty brutal one at that for emerging markets.
Again, I think that the volatility is here to stay, and that's the volatility of the investor mood. Okay. Perhaps the market volatility itself will be suppressed with interest rate remaining low. But again, I would strike that what was with us in 2012 is likely to stay in 2013. The Greek situation isn't resolved. The fiscal repair in the United States is likely to be slow. The EM growth trajectory is perhaps more hopeful, and this is what is different versus 2012, because again we've gone through a period of political transition in China. We have seen the inflation in EM coming down to a more subdued level. We've had a more prolonged period of lower interest rates, and that should start feeding in the growth momentum. So this is one brighter spot relative to a pretty uncertain 2012.
Right, but despite the volatility in 2012, some of the emerging markets have actually given positive year-to-date returns. India has, of course, been a superlative performance there. Do you think 2013 would be a build-up on that, or are we still going to be looking at this broad range and the market essentially adjusting itself within that?
I think we will have a greater bifurcation, just like we had this year, between performance of the markets. So export-oriented markets this year, Taiwan, China, Brazil have done rather poorly. Those markets have hardly moved, and clearly more consumer-oriented markets or the markets that had very, very low base, like India in 2011, have done well. And I expect that next year we will continue having the same question marks over the premium one pays for the stability of growth in the likes of Philippines, Thailand, and Indonesia, and then the fickle nature of the export recovery in the markets that are truly cheap. And again, if you look at Taiwan, Korea, they have rarely been cheaper on the pure multiple terms, but the outlook is more clouded.
Do you think things could be changing for China this year, because the market has underperformed over the last 3 years?
So what China has gone through this year is the period of decision paralysis. So following a great monetary expansion in 2009-2010, China came to an abrupt stop, and we have seen that manifesting itself in the real cash crunch in the economy. It's still very much an economy where state-owned enterprises dominate, and when the government turns off the tap, the liquidity within the companies effectively ceases. So going forward, given that the political transition is completed, we would expect the money circulation to improve. We would expect approval of projects that is manifesting itself in, say, steel or cement prices that started to pick up. Sure. And again, that should give a pretty robust kick to growth. Again, don't mistake it for 2009 when we had huge disbursement of loans.
Okay.
I think that mistake is not going to be repeated. But we are likely to see a positive growth momentum, and that should lift parts of Asia, that should lift some commodity markets, that should, on margin, help Brazil.
Would it be a conclusive statement to make right now that China has averted a hard landing? Even though we've seen a slowdown in growth rate, people are talking about the growth being more qualitative than just numbers coming in there because of an imbalanced growth in the economy?
I would think so, because we've seen some move on the export side. We've seen some move upwards in capacity utilization. And again, it's an economy that is not particularly geared on the aggregate level. So it is very much, I think at this point, an administrative decision of renewing some of the contracts that should allow for moderate pickup in growth.
Where do you place in currencies in this entire picture? There is an expectation that, with the whole confusion with regards to how the fiscal cliff is managed, at least for the initial part of the year, there would be strength in the dollar. There would be a bit of risk aversion that would come in safe haven assets. What would that mean for emerging market currencies?
Sure. Clearly, fiscal cliff, if it were not to be averted, would be a serious blow to risk markets. That's a 4% contraction in the largest economy in the world. However, again, our central scenario is that fiscal cliff will be averted by the 11th hour deal. If you were to look midterm, given the commitment of the Fed to keep rates low, we're likely to see continued money printing. That spells a weaker dollar environment midterm. Again, I'm not in a position to tell you what's going to happen in the first quarter.
Yeah.
So midterm EM currencies do stand out, although perhaps less so than they did in 07-08, in a way of giving positive carry and having a positive growth dynamic. So we continue to like some of the high-yielding EM currencies, such as Brazilian real, Mexican peso, and Asian currencies that we view as undervalued.
What about inflation for emerging markets, given the easy money policy? You spoke about some ease coming in on the inflation front.
Well, inflation has stepped down from high level, and we've seen a pretty rapid deceleration in inflation, and I would say that actually we've seen the trough in the inflation expectations that should start gradually building up. Again, we don't expect a commodity shock to strike in 2013, and that would be one of the things that could continue putting pressure. There are clearly some structural underpinnings for higher inflation, such as consumer story building up and labor cost rebalancing. But again, we think that that would be more moderate than, say, in 2008.
All right. Masha, we'll talk a little bit more about the India story, the macro story, and what you are liking in the region in terms of stock, the India story. Were you surprised by the outperformance that India showed in 2012, given that you've been you hold an underweight rating on the region?
Look, the unsurprising element has been the bounce in the really distressed industrials, and that's just a question of very low base and very low base of expectations. Where perhaps we've been more surprised is with the holdings that we had, which was banks, and if you were to look at private sector banks, say Yes Bank or HDFC Bank, they have increased 60-70% in value. That has been a very robust show. Clearly, the surprise has been also the very strong performance of staples that continue to re-rate.
So why are you still underweight India?
Look, the currency, I think, tells the story. We've had a euphoria following the government moves towards the more decisive policy making and resolution of some of the structural gridlocks. And then, obviously, currency have retreated back with the markets effectively concluding that it'll take longer, i.e. the period of removal of the major structural issues that plague the economy and that ultimately result in unsustainable, arguably, fiscal deficit. So we still think that that move would be quite slow, although we're very encouraged by the passage of the number of pieces of legislation, by the resolution of the partial insolvency of the electricity boards, by the FDI law on retail. But again, as far as real businesses are concerned, it will take, the repair will take longer, and we think that valuations are accounting for a rapid reversion in negative free cash flows to a more positive territory, and again, that's more excessive.
Right. Even though your strategy for India is more stock specific, on the macro front, to your mind, stepping into the new year, what is the biggest risk that India faces?
Well, clearly oil shock would be one, and the lack of continued progress on policy-making momentum, because the markets will come and penalize you. And again, you are seeing the threat being manifested in rupee that is retreating back and is behaving very much like a risk currency versus a risk currency that has a positive trajectory of policymaking.
But don't you think that if the rupee weakens, then India becomes a currency trade for foreign investors like you, because the balance of risk then shifts and it will be more attractive to come into the market at that time?
Again, high carry is only as good as much as one concludes that deterioration is not in the offing. If you think that the fiscal balance is unsustainable, the high carry in itself doesn't present such an attractive offer.
But are you expecting that the rupee can actually slide to 58, 60 odd levels again?
Again, currently we're seeing some positive work that the government is doing to repair midterm fiscal situation. If that continues, we should see gradual appreciation of the currency.
What's the call on how much upside there would be for India? Because India still trades at a premium to the other markets.
Clearly, the answer is in earnings growth and in cash flow generation. If you see pronounced policy-making momentum and liquidity come into the companies that are starved of that are growth companies but are yet unable to fund their growth, you will see potential re-rating of the multiples back to the highs. If you don't see that and you continue having cash crunch in the growthy part of the economy, you will see gradually that enthusiasm petering out.
Explain that, especially with a sector like infrastructure, where you're saying that there is potential of growth, but there's not enough money to fuel that growth.
Look, take a company like Jain Irrigation. If you were to step back and say, well, it's a company that sits in the juncture of one of the most attractive points of the economy, right? Clearly, India needs, greater self-sufficiency in food production. The productivity of the land has to improve. This company had to degrow 30% this year in order to become solvent. It had to, and although it has commitment from the government to support farmers, extrapolate their commitment, the company effectively had to raise a pretty serious amount of capital, diluting current shareholders, and degrow 30% to return back to some sort of semblance of balance and reestablish a new point of growth. Clearly, look, it's a small cap company now, but 2 years ago it was a market darling where that traded at a very, very high multiple, where the growth trajectory was extrapolated to be smooth without much thinking given to the balance sheet and the cash flows.
So when do you think value would emerge in industrials, power utilities, cap goods, sectors which are very closely related to the investment cycle?
Look, we've seen the start of the unlock of the value with the reform of the electricity board financing and some tentative moves towards pricing reform. And again, I would stress here, it's not about RBI or RBI's next move in terms of cheap money. It's the much more important thing in unlocking the decision-making of corporates is the viability of the projects mid-term. And for that, you need pricing reform. Clearly in the power sector would be one of the examples. You need the unlocking of the bureaucratic conundrum, such as approval of projects to supply adequate coal. So these are multiple decision-making and policy issues that need to continue being resolved. And again, if you think about it, there are a myriad of issues that prevents corporates from investing. So again, we need to see continued ticking of boxes on that front to get these companies that are currently hugely free cash flow negative, that have immense funding needs to execute on the projects, and where the payback is 5 years out. Clearly you need to this ticking of boxes to realize the value of the company.
So just to sum it up, aside of private banks, which you hold in India, you're evaluating autos, you're looking at industrials, and consumer staples is in a void.
It's not an outright avoid. We currently don't own the companies. Again, I've recently met with a company like Godrej, and you know, clearly it's a very interesting story. We'll continue looking and evaluating the opportunities of growth, perhaps outside of India. That's a different angle. And you know, should we conclude that it's a powerful value creator with a strong midterm growth in categories that are not yet penetrated, where premiumization is a real possibility, you know, we may enter in a holding of the stock. But again, that stock gets evaluated alongside with the Cosbics of this world, where perhaps the story was less demanding and the price appreciation was just as powerful.
All right. Would a stock like Bajaj Auto then come on the radar because they are very export-oriented and the stock has been doing well?
Sure. Bajaj, Maruti, Tata are the companies we are looking at, although I won't commit to us pulling a trigger.
What is it that you would stay away from?
So again, sectors with big political meddling or continued political meddling. So telecom will be one where we burn our fingers being invested in one of the companies in the sector, where again we've realized that the asymmetry of information between the investors and the government is quite high, right? The government tends to want to regulate and to impose very high tax on the sector via you know, new frequency questions, et cetera, and again, for us, this is a question of diminishing returns. So any sector with large government regulatory participation provides us with less clear asymmetry of returns, where the risk would be you know, outweighed by returns.
Would you avoid PSU banks as well then, even though there's value emerging in some of them?
Sure. Again, as a rule in the fund, we own very few state-owned businesses. Okay. In fact, out of 70 holdings, I think we have only 3 state-owned companies. Okay. And this is a reflection of the view that you have a very complex set of shareholder objectives typically, and if a majority shareholder has an objective that implies socialization of shareholder value for the greater of the good, we certainly will find that difficult to reconcile.
Return expectations, Masha. I mean, closing out 2012, stepping into 2013, what are the return expectations that you have from markets across?
Look, this year, markets returning roughly 15%, which is in excess of earnings growth. So there has been some mild re-rating, plus we had a dividend yield of 3.5%. I would expect the earnings growth next year to be more robust. From the pretty low base of this year. We've had more companies disappointing this year than beaten numbers. And again, that low base should help earnings growth of say 15% plus the dividend yield. So I think that the returns of 20% is not unheard of. Clearly, currency is variable. Again, EM currencies are cheap, and you know, currencies like Brazilian real, again, large EM component. You know, we have favorable view on. So again, 20% return is supported by inexpensiveness of multiples, low base for the earnings growth, fairly benign inflation outlook.
What about safe haven assets? How do you expect gold to perform? And you know, what is your hedging strategy really in your portfolio, if you have any?
Sure. We tend to employ a portfolio of options, out of money put options. So gold perhaps is a less prominent asset in our hedging strategy. But again, if you were to look at the midterm outlook for money printing and for dollar, you know, clearly that indicates that potentially the correlation, a negative correlation between the dollar and gold may be very much in place. So some of our value funds have gold as a hedge, and perhaps it does make sense in the context of that strategy.
Do you expect gold prices to continue to move up?
Well, you tell me, would Indians continue buying gold?
Oh, well, yes. Indians always favor gold.
I know that this year it has been more of a challenge, right?
Yeah.
Jewelry demand, given the combination of weak rupee and rising prices, have been dented. But no, clearly, the dollar, perhaps the outlook for dollar is a more important variable. So we would expect some price stability slash some modest price appreciation.
For a market like India as well, do you use that as a hedge? Do you play India via the index put options?
No, we do it on the aggregate for the emerging markets as well as credit-related instruments.
Okay. Before we wrap up, Masha, just wanted your broad summary of how you think 2013 might be. As a fund manager, are you excited about the new year? Are you stepping in on a bit of a cautious note?
I am excited about the fact that some of the large EM economies are coming off from the period of pronounced slowdown. So clearly, a low base for an economy like China provides a nice starting point for the gradual demand growth. What I'm less excited about is the fact that the issues that we alluded to at the beginning of the program are here with us to stay, and this is a very daunting realization that the fiscal issues, that indebtedness, are very slow-moving properties. We're not going to have a cathartic event, hopefully, of cleansing and major default. Hence, you can deliver only through painful cutting off of obligations and through gradual reestablishment of competitiveness. And that is a difficult thing to accept, and this is something that will continue moderating returns over near to midterm.
Masha, thanks very much for joining us and giving us your views on emerging markets in the year 2013. With that, we come to the end of this special edition of Global Mantra, but catch you with another special guest next week, same time.